Okay, let's unpack this. You've diligently put your money to work in a brokerage account, right? Building towards your future goals. Could be retirement, a down payment, whatever. But as you watch those numbers go up and down, have you ever really stopped to think, what is protecting that money if, the firm itself runs into trouble? And what about that cash line item you see? Seems simple,
Yeah.
but is all that cash really yours to spend or invest right away? Or is there maybe a bit more to it?
That's exactly what we're diving into today. This is all about demystifying brokerage accounts for you, the informed investor. We're going to peel back the layers on protection, make it really clear how bank deposit safety differs from protecting your securities. We'll talk about which agencies actually have your back and, crucially, help you understand and, well, strategically manage that cash sitting in your investment portfolio. Our goal here is to turn all that financial jargon into, clear, actionable insights. Give you a real edge.
Okay, let's kick off with something fundamental. A distinction maybe a lot of us gloss over. We all pretty much know our bank savings are covered by the FDIC, right? Federal Deposit Insurance Corporation. But when it comes to investments, stocks, bonds, ETFs, in our brokerage accounts, is it the same deal? Is the FDIC covering those too?
Yeah, that's a great question, and it taps into some important history. What's really interesting is that for a long time, money in the securities markets didn't have specific protection if the brokerage firm failed. None at all, really. That changed pretty significantly in 1970. That's when Congress stepped in and created the Securities Investor Protection Corporation, or SIPC. So the short answer is no. Brokerage accounts are not FDIC insured. They're separate things entirely. FDIC covers cash in banks, generally up to $250,000 per depositor, per bank, per ownership category.
Yeah.
SIPC was built for the securities market, tackling a whole different kind of risk.
Okay, crucial difference right there. So SIPC is an FDIC. What does it do then? Is it like insurance if my stocks tank, if the market goes down or I pick a loser?
And that's probably the biggest misunderstanding out there. SIPC is there to protect investors against losses only if their brokerage firm goes bankrupt or becomes insolvent. Its job is to help you get your cash and securities back if the broker fails, and somehow your assets are missing from your account. It absolutely does not cover losses from market ups and downs, or losses from fraud, or even just bad investment advice on a legitimate investment. Think of it more like insurance for the financial plumbing, making sure your assets are actually there even if the firm holding them collapses, not guaranteeing their value. SIPC protection covers up to $500,000 in total value per customer, but, and this is key, that includes a maximum of $250,000 for cash claims.
Right, $500,000 total, but only half of that max for cash. It's a decent chunk, but those limits matter. Can you give us an example? Walk us through how that plays out in a real scenario.
Absolutely. Let's picture an investor, say, Sarah. Her brokerage firm suddenly goes belly up. It's insolvent. Now, Sarah has $300,000 in cash sitting in that account. She also has $150,000 worth of stocks held in street name, meaning the broker holds them legally for her, which is super common. And she also has another $450,000 in stock certificates that she originally registered in her own name, but she deposited them with the broker just for safekeeping, easier management. So, under SIPC rules, here's the breakdown. First, the cash. She has $300,000, but SIPC's cash limit is $250,000. So she gets $250,000 back.
Okay, hits the cash limit. What about the other $50 I cash?
That remaining $50,000 cash is unfortunately not covered by SIPC in this scenario. Second, the street name securities. She gets all $150,000 of those back. So the $250K cash plus the $150K securities. That's $400,000 total from SIPC, well within the $500,000 overall limit.
Got it. And the stock's registered in her name, the $450,000 worth.
Good question. Those are treated differently. Since they were registered in her name, they're considered her direct property, just held by the broker. SIPC helps facilitate getting those back to her directly. They don't count against the $500,000 limit because they weren't technically missing due to the broker's failure. They were always clearly hers. So this example really shows SIPC focuses on restoring missing customer assets from the failed firm.
That makes it much clearer, especially the distinction with personally registered assets.
Yeah.
Okay, so beyond market drops and fraud, are there specific types of investments SIPC just won't touch? even if the brokerage collapses.
Yes, absolutely. And you need to know these exclusions. SIPC protection is specifically for securities. So certain things just fall outside that definition. For example, commodities, futures contracts, any currency you're holding, those aren't covered. Also, fixed or index annuity contracts are generally out. Same for many types of limited partnerships, LPs. And any security that isn't registered with the SEC, the Securities and Exchange Commission, usually ineligible. Think really speculative stuff or private deals.
Why are those excluded?
It's usually because they're regulated differently by other bodies, or they just don't fit the legal definition SIPC was designed for. Now, they might have other insurance, maybe from the product provider itself, but not from SIPC. You'd have to check that specifically.
Okay, that makes sense. So given these limits and exclusions, how can you, our listener, make sure you are covered? What steps should you take?
The number one thing. Verify your brokerage firm is an SIPC member. Simple as that. SIPC only covers member firms. Now, if you're with a big, well-known name, they almost certainly are. But, it doesn't hurt to check, especially with smaller or newer firms. Also, sometimes your broker uses another company, a clearing firm, to actually handle the trades and hold the assets. That clearing firm needs to be an SIPC member, too.
Where do you check that?
Most firms will state their SIPC membership on their website, usually pretty prominently. Or you can go directly to the SIPC website, cpc.org, and look them up. And another really good practice, keep good records. Your trade confirmations, your account statements. If the worst happens, having clear records makes the whole recovery process much, much smoother.
Good advice. Now, what if the issue isn't insolvency? What if it is fraud? You said SIPC doesn't cover that. Who do you go to? What happens then?
Right. For fraud or, other kinds of misconduct that don't involve the firm actually going bankrupt, you're looking at different players. The main ones are the Securities and Exchange Commission, the SEC, and the Financial Industry Regulatory Authority, which is a FI and RA. The SEC is the big government regulator overseeing the whole industry. FI and RA is more of a self-regulatory body for brokers themselves, setting rules and enforcing them. If you suspect fraud, you'd typically file a complaint with both the SEC and FI and RA. Their enforcement teams can investigate. Sometimes they can help investors get restitution, but it's not guaranteed, unfortunately.
And I recall something about unauthorized trading. That sounds like a specific kind of fraud. How does that work, especially if you lose money because of it?
Yeah, unauthorized trading is a serious issue. It happens, sadly, and it can cause significant losses. Sometimes, if it's widespread, it can even contribute to a firm becoming insolvent. So if you spot trades on your account you did not authorize, the absolute first thing you must do is contact your brokerage firm in writing. An email, a formal letter, document everything. State clearly which trades were unauthorized, the dates, the amounts. Create that paper trail. It is critical.
Why is the paper trail so important?
Because if the firm does later become insolvent, partly because of this kind of activity, you might have to prove to SIPC that those specific unauthorized trades caused your losses. That written complaint is your primary evidence. Now, if the unauthorized trading happens, you lose money, but the firm doesn't go insolvent, then you'd usually go back to FINRA or maybe your state's securities regulator. They have processes like arbitration to help resolve these disputes between you and the firm and potentially get your money back. But again, documentation from day one is key.
Okay, so SIPC is that foundational layer, but it's very specific to insolvency. Are there any extra layers, maybe for people with bigger accounts, that exceed the SIPC limits?
Yes, and this is something not everyone realizes. Many established brokers and dealers get extra insurance on top of SIPC. They buy it from private insurance companies. It's often called excess SIPC insurance. And the limits on this excess coverage can be really high, like tens of millions, sometimes even over $100 million per account.
Wow. But does it cover more types of risk, like market losses?
No, and that's the crucial point. Excess SIPC works under the exact same rules as regular SIPC. It only covers losses if the broker becomes insolvent. It does not cover market declines, bad investments, or fraud. It just raises the dollar amount of protection for that specific insolvency risk. But when you combine SIPC, this potential excess SIPC, plus the way assets are recovered proportionally and how your personally registered stocks are returned directly, it actually means that historically very few investors nationwide have lost their actual assets due to a brokerage insolvency when SIPC got involved. The system for that specific risk is pretty robust.
That's really reassuring to hear. Okay, that covers the protection side of things really well. Let's shift gears now. Let's look inside the account, that cash balance. We talked about how it feels like found money sometimes. What do we really need to understand about mastering that brokerage cash?
Yeah, found money is a good way to put it because it captures how people often react. But that label, brokerage cash, like you might see on an app or statement, it's often just the top line number, the gross amount. It's the total cash linked to your account before they take out things like unsettled trades. You sell a stock, but the cash hasn't officially cleared yet. It takes a couple days usually.
Right, T+1 or T+2 settlement.
Exactly. Or maybe collateral needed for margin trading. That top line number includes all that stuff. The real number, the cash you can actually use right now to buy something else or withdraw to your bank, that's usually called something different, maybe buying power or settled cash, or like Schwab calls it, cash available for withdrawal. So the key insight is that big cash number you first see. It isn't necessarily walking around money. You need to understand what makes it up to know your true liquidity.
Yeah, that's huge clarification. So moving beyond just seeing the number,
Yeah.
how does this cash pile up in the first place? What are the common ways it gets there?
Well, it typically builds up from a few main sources. Proceeds from selling stocks or bonds are a big one, especially if you don't immediately reinvest that money. Dividends from stocks or interest payments from bonds, if you haven't set them to automatically reinvest, DRIP programs, they land as cash too. And of course, any money you transfer in from your bank account to fund trades. And for some people, like you said, it does feel like found cash because it can accumulate sort of passively. Maybe dividends just kept rolling in, or you sold something months ago and forgot about the proceeds. You check your account one day and whoa, there's more cash than you thought, which really just highlights why it's important to regularly look at your account and have a plan for that cash, not just let it sit there forgotten.
Okay, so you've looked past the top line number. You've identified your true cash available for withdrawal, your actual liquid funds. Now what? What are the smart strategic options? How do you put that cash to work, or at least manage it effectively? This feels like where you can really optimize things.
Exactly. And because everyone's situation is different, your risk tolerance. When you might need the money, there isn't one single right answer. But we can map out the main strategies. Option 1, probably the default for many long-term investors. Reinvest it. Buy more stocks, bonds, ETFs, whatever fits your plan. If you still believe in your investment strategy and you can handle the market's short-term bumps for long-term growth, putting cash back to work makes sense. You could average into existing positions, rebalance back to your targets, or maybe explore something new. Setting dividends to reinvest automatically is a great way to do this passively. Helps compound return.
Right. Avoids that cash buildup in the first place.
Precisely. Letting cash sit idle, especially in a rising market, has an opportunity cost, right? So for growth investors, this is often the go-to. Okay, option 2. Maybe you think you'll need this money relatively soon, like in the next few months, maybe up to a year. Or you just want somewhere super low volatility to park it for a bit, maybe earn a little interest. Then you could park it in a short-term debt instrument. Lots of choices here. Treasury bills, or T-bills, are very popular. Backed by the U.S. government, super safe, often state, local, tax-free.
CEs too, right? Like from a bank.
You could potentially buy CDs through your brokerage, yes. They offer fixed rates for a set time. Another option people talk about are ultra-short bond funds.
Yeah.
These funds buy really short-term debt, think commercial paper, government notes maturing in under a year. They aim for slightly better yields than just letting cash sit. But, important note, they are not money market funds. They can fluctuate a tiny bit in value, they have fees, and their performance can depend on interest rates. So you need to understand what you're buying there.
Okay, so reinvesting for growth or short-term instruments for near-term needs or stability. What about just doing nothing, leaving it in the account?
Well, that's option 3, just leave it alone. And it's not like it just sits there doing absolutely nothing, usually. Most brokers have what's called a sweep program. Your uninvested cash gets automatically swept somewhere overnight. Where it goes depends on the broker. Some sweep it into partner bank accounts that are FDIC insured, so you get bank-level safety.
Probably not much interest, right?
Generally, no. The interest rates on these FDIC-insured sweep accounts are often very low, like a basic savings account. Other brokers might sweep it into a money market mutual fund. These funds invest in safe short-term debt, too, aiming to keep a stable $1 share price. But key difference. Money market funds are not FDIC insured. There's a very small, historically rare risk they could lose value called breaking the buck. So the main downside of just leaving it, often a very low return. Significant opportunity cost compared to other options. And, the brokers make money managing these sweep programs.
Okay, makes sense. So reinvest, park short-term, or leave it in the sweep. Is there a fourth option?
There is. Option 4, which might sound a bit odd in an investing chat, but it's valid. Spend it. I mean, if this cash accumulation fits into your broader financial plan, Maybe you sold stock specifically to fund a kitchen renovation, or you saved up dividends for a trip. Then use it. A lot of brokers now have cash management features built in. You can pay bills directly, use a debit card linked to the account, things like that. Both Schwab and Interactive Brokers offer features like this. The key is just being intentional. If spending it makes sense for your budget, your goals, and doesn't mess up your long-term investing plan, go for it. It is your money after all.
That's a really practical range of choices. Okay, let's say someone listening is very risk-averse. They're primarily focused on safety for this cash. What are their absolute lowest risk moves from that list?
For the truly risk-averse investor focused purely on capital preservation and liquidity, the choices narrow down. Number one is probably letting the cash stay in the default sweep program if that program sweeps into an FDIC-insured bank deposit. That gives you the bank-level safety net. Number two would be actively buying U.S. Treasury bills directly. T-bills are considered essentially risk-free from a credit standpoint, backed by the U.S. government. Those ultra-short bond funds we mentioned, they might offer a slightly higher yield, but they do carry a sliver more market risk than FDIC insurance or T-bills. So the most risk-averse might skip those. It really comes down to prioritizing safety above all else, accepting the lower return as the trade-off for that peace of mind.
Wow, okay, what a deep dive that was. We've really gone from the safety nets, like SIPC protecting against firm failure, all the way to the nitty-gritty of what that cash balance in your account actually means and what you can do with it.
Absolutely. And the core theme here really is the power of knowledge. Just knowing SIPC is about insolvency, not market risk, changes how you think about your portfolio safety. And seeing the difference between that top-line brokerage cash and your actual available cash, that's not just semantics. It lets you make deliberate, smart choices instead of, letting things drift or acting on fuzzy information. It shifts you from just watching your account to actively managing it.
So the next time you look at your investment statement, you've got a much sharper lens. You could look beyond just the gains or losses for the day and maybe ask yourself, am I really using all the tools here? Do I understand my protection? Am I deploying my cash intentionally? Is my approach truly aligned with my goals and how much risk I'm comfortable with? Getting that level of control, that informed perspective, that's not just smart investing. It feels like a pretty powerful step towards real financial confidence, something to really think about.